Straight to the questions. Diamond Hands, I love that name. Today, I'm going to be giving a short presentation on a specific topic, and then I'll do Q&A. I'm doing well, Abby. Thank you. How about yourself? I'm trying out a Saturday live stream to see how many people we get in here because usually I do it during the week, during market hours, which that means most people are probably working. So let's see how many people we can get in here. All right. I'm going to go ahead and how's it going, everybody? I'll do Q&A after this presentation. I'm just going to wait and see how many people we can get in here. All right, I don't know how many people we have, but we're going to get started. So in today's short presentation, I want to talk about a mistake that I made in my Tesla position. As many of you may know, if you've seen any of my past videos or live streams, you'll know that my Tesla position is the largest position. So if we just go ahead and take a look at it, we can see that it's still doing well. It's fine. But I'm going to talk about a mistake that I made last week, which is pretty stupid. And we can all learn from it and then understand that I make mistakes too. All right. So I recently made a big mistake with my Tesla position. On January 26th, 2021, I purchased the 800 put option expiring at the end of the week, which was January 29th. Now at the time, Tesla was trading for around $885 per share. So purchasing the 800 put with just a few days to expiration, that means that that put was significantly out of the money since the stock price was at $885 and I purchased the 800 put option. So if we go to my trade activity here, I have this pulled up. So we can see that on January 26th, I purchased one contract of the 800 put option expiring in the January 29th weekly expiration cycle. Now this included the earnings announcement that Tesla had, and so that was the reason for this trade. Since Tesla is the largest position in the portfolio and I wanted to protect against a big decrease in Tesla's stock price, I purchased that 800 put option as a very cheap protective put. So since I had 70 shares of stock and multiple bullish call spread positions, the trade was a cheap protective put to hedge against a huge Tesla sell-off post earnings. So on January 29th, Tesla closed at $793 per share, and that means that the 800 put was in the money. So I did not close the 800 put position on accident. I would have closed it, but I was not paying attention because I was admittedly driving into the mountains to meet my family for a vacation. So this was on Friday. I wasn't paying attention, and essentially I let this put option expire in the money. Can everybody can see when I go full screen, right? I just want to check. You can see me and you can see the presentation. Just need a quick yes. Okay, good. All right. So here we go. So I did not close the 800 put position. So my stock position before expiration was plus 70 shares. And then I allowed the 800 put to expire in the money. And that means that if you allow an option that you own to expire in the money, that option will automatically be exercised. So I owned 70 shares and then the 800 put was exercised. And so if I owned 70 shares and one contract of the 800 put was exercised, what was my new stock position after that put was exercised? So this is a question that I want to ask everybody. We got negative 30, 170, negative 30, negative 30. All right, good job. You guys, it's not 170. The correct answer is negative 30. And this is why. So if my stock position before expiration was a positive 70 shares, meaning I owned 70 shares of stock, and then the 800 put was exercised, since the 800 put was exercised, that means that I sell 100 shares of stock. So if I own 70 shares and I sell 100 shares, then my new stock position is negative 30 shares, which means I have a short stock position of 30 shares. So if you own 70 shares of stock and you exercise a put option, you will sell or short 100 shares at the put's strike price, which is $800 in this case. And since I only owned 70 shares, I effectively sold the 70 shares that I owned and then shorted an additional 30 shares, because when you exercise a put, you're going to sell 100 shares. So basically you can take, to make it simpler, you take your existing stock position, subtract 100 shares from it, and that will be your new stock position if you own stock and then one contract of a put option is exercised. So since I own 70 shares, we subtract 100 shares from that. My new share position is a short stock position of 30 shares. So this is not what I wanted to happen, because I wanted to continue holding the Tesla shares as a long-term hold. And so obviously when this happened, I was super upset because I did not want to sell those shares. And then let's talk about why, or first of all, let's talk about how I unwound this position. So when this happened, I knew I made a mistake, but I didn't panic because I knew that most likely everything was going to be okay. The worst case scenario would have been if Tesla had gone up like $100 over the weekend, because then I would have been short stock as opposed to long the shares, and that would have been bad. But to get back to my original position, I closed the 30 shares that I was short, and then I repurchased the 70 shares that I originally had, and I did this on Monday. So the share price was around $815 when I made these trades, which meant that unfortunately I did miss out on share price appreciation, since I was short stock through a price increase when I should have been long the original 70 shares. So missing out on the share price appreciation, that did cost me money, but the bigger consequence is due to taxes. So the biggest cost of this mistake was locking in a short-term capital gain on accident, since the shares were all purchased in between March and May of 2020 for an average price of $211 per share. So selling these shares in January, which is not a year after I purchased them, and selling them for $800 a share means that the profits were taken on a stock position held for less than 1 year, and this means that the gains on that position fall into short-term capital gains. So I have a quick breakdown here and some examples of how much this cost me tax-wise. So if we have a share purchase price of $211 per share on average, and then I sold the shares at the put strike price of $800, then my sale price is $800 per share. So the profit on that would be $800, which is the sale price, minus the purchase price of $211 times 70 shares, which comes out to a profit of $41,230 on the share position. Now, long-term capital gains, meaning if you buy something and you sell it for a profit and you hold it for longer than 1 year, that's called a long-term capital gain. And a long-term capital gain is lower than short-term capital gains in most cases. So I took 15%, which is basically the standard long-term capital gains tax rate, and I multiplied that by the profit of $41,230, and then we get a tax on that of $6,185. Now, since I accidentally locked in a short-term gain on this, I went and included two different examples of short-term capital gains. So the short-term capital gains tax will be your ordinary income tax rate. And so let's say the ordinary income tax rate that you pay is 25%. So based on that $41,230 profit times 25%, the tax on that would be $10,308. Now let's say if you're a really high earner and your tax rate is 35%, then the taxes you would pay on that short-term capital gain would be $14,430. So clearly, the biggest consequence of this mistake here was tax related, because instead of holding the shares for longer than 1 year and accidentally locking in a sizable profit on a position that was held for less than 1 year, the taxes go up dramatically. So at the end of the day, there still was money that was made on that trade, and that's fine. But this was a huge mistake, and it was just simply from forgetting that I had this short-term weekly option position in Tesla that was protecting against a big downside movement post earnings. And since I allowed that put option to expire in the money, unfortunately, that locked in a short-term capital gain, and the taxes on that are going to be much higher than the long-term capital gain. So I am sharing this. The first reason I'm sharing this is to show you what happens when you don't own or you're not short 100 shares of stock. So you have a stock position that's less than 100 shares, and then you have an option that is exercised. And basically what happens, if you own less than 100 shares and you exercise one put option, basically you just take your share position, subtract 100 shares from that, and then you get your new stock position after that option settles. So that's the first reason I made the video. The second reason I made the video is that I thought it'd be an interesting topic to talk about how this little mistake that I made actually has a big consequence in terms of taxes. And then lastly, I made the presentation to show that even I make mistakes. This is a pretty stupid one, but I figured it'd be good to make a short presentation on it. So if we go and look at my trades here, you'll see that this was the original put purchase. So on January 26th, I purchased the 800 put for $6. So $600 in premium was paid. So this was a cheap hedge on a very profitable position. And this was to protect against a catastrophic sell-off after earnings for whatever reason. So then we can see on February 1st, we can see that I closed this position. So my position was negative 30 shares, meaning I shorted 30 shares. And we can see that right here in the description. It says that I bought 30 shares. And it says BTC right here, which stands for buy to close. So when you're short a stock position, to close that position, you have to buy back the shares. And so that's why it says here BTC, which is buy to close. And then immediately after covering the short position, I re-established the original share position of 70 shares. And that's from this transaction here. And it says BTO, which means buy to open. So I re-established the position. I lost money. I lost a little bit of money from the share price appreciation, but I lost more money in terms of locking in a short-term capital gain when I planned to hold the shares for longer than 1 year. So I'm going to go through some questions now. Yeah, so that LT said I wasn't thinking about the tax part. Yeah, that's the main reason for making this, and that's the biggest cost of this stupid mistake here. Alex says, if you hold options for a year, is that long-term capital gain? I think so, but I'm not sure. Honestly, as much as I know about options, I need to learn more about option taxation. My guess is that it would be a long-term capital gain. But for the most part, when we're trading options, very rarely are we going to hold an option position for longer than 1 year. And so most of the time, it's going to be short-term capital gains. But on a stock position, it's very common to hold a stock position for longer than 1 year. And that was my intention here. But unfortunately, I completely forgot that I had this expiring put option during the week of earnings. And basically, I accidentally sold all the shares that I had purchased last year. So I locked in a short-term capital gain on the shares. And unfortunately, that means that the taxes on that profit are going to be much higher. AMG asks, just to be clear, this was still a profitable trade though, right? It's not possible to somehow incur a greater tax liability than the total of realized profits, right? That's correct. So it's still an overall profit. So the profit on the share position, based on the entry price and sale price, the realized profit was still just over 40,000. And based on those example tax rates I showed you, basically the amount of taxes that'll have to be paid on that gain are much higher since it was accidentally locked in as a short-term gain. But if I would have held the shares for longer than a year, then the taxes would have been much lower. Since long-term capital gains taxes are lower, typically lower than the short-term capital gains tax, because short-term capital gains is essentially your ordinary tax rate. So the more money that you make, the more advantageous the long-term capital gains tax is. So let's say you're a super high earner and you pay 40% in taxes a year, then that long-term capital gains tax, or holding assets for longer than a year, is super favorable for you, because if you lock it in as a short-term gain, you're going to pay 40% of the profits. But if you lock it in as a long-term gain, you'll pay 15, 20%, whatever it is. I have to brush up on what that's going to be, because now that we have a new president in office, I think he mentioned he's going to change the taxes. Let's see here. Steve says, are you no longer with tastytrade? No, I left tastytrade in July of 2016. TTS? I'm not sure what TTS is. Someone said, wait, how did you sell them without knowing the expiry? I'm not sure what you mean. Short-term capital gains still depends on your tax bracket, correct? That is correct. Short-term capital gains depends on what your personal earnings are, and the more money you make, the higher your tax rate will be, and therefore the higher your short-term capital gains taxes will be. So the more money that you make overall, the more advantageous it is to hold assets for longer than 1 year, because when you hold assets for longer than 1 year, if you eventually sell it for a profit, it will be a long-term capital gain, which will be taxed at a much lower tax rate if you are a high earner. Someone said, put options we bought may be forced to exercise. The only time you will be forced to exercise an option is if you hold an option through expiration that is in the money. So in this case, if we look at expiration on January 29th, Tesla shares closed at $793. I owned the 800 put option, which means that the 800 put option was in the money. And therefore, since I held that in the money put option through expiration, it is automatically exercised. So that's the only time you'll ever be forced to exercise an option. You will never, when you own the option, you have the ability to choose when you exercise it before expiration. And so if you decide that you never want to exercise that option, then you don't have to. But if you hold an in-the-money option through expiration, it will automatically be exercised, unless you notify your brokerage firm that you do not want to exercise those options. That's the only scenario where it won't happen. Guy says it was a sign from above to exit the position. No, I didn't want to exit the position. But I'm still being very defensive with the Tesla position. Actually, let's see here. I already talked about that in the last stream. So I don't have any naked call options anymore in Tesla. Everything is a spread position. So these are all call spreads. I have the 700, 800, 500, 600, and then the 900, 1500. This is a free call spread. Worst case scenario is this ends with a $13,000 profit. And then the 500, 600, well, this one's free too. So I have two call spreads that I can't lose any money on, but I no longer have any naked call options. Do I have to report any taxes even if I didn't make more than 100? Brady asks. Yes, you should report. You need to report your profits and losses from your trading activities. You don't want to run into any problems with the IRS. Neo says, if I'm bullish on Tesla in the long run, say 1 to 2 years from now, what would be a good option strategy to use? Well, my favorite strategy is to buy. If you're really bullish on a stock long term, my favorite strategy is to buy long dated, deep out of the money options. So that would be like go to March 2023. Stock is at 850. If you're really bullish on Tesla over the next 1 to 2 years, then this is how I would play it. I would go to a long dated expiration, such as this one, which has 2 years to go. And then I would look at like probably like the 1500 or something like that. It depends on how bullish you are. So the lower the strike price of the call, the more you're going to pay. So if you bought the 1,000 strike, that would cost you 31,000 for one option. If you went to the 1,500, that's going to be 22,000 for one option. Or you could do a spread. So let's say Tesla's at 850 right now. You could do a call spread to make it cheaper. And so you could do a really wide call spread. If you go to a super long-term expiration, I would really recommend doing a really wide call spread, because if you do a 900, 950, like it's not really going to be sensitive at all to the stock price. If you look at the delta of this 900, 950 call spread, the delta is 2, which means if Tesla goes up $100, you're going to make $200. So this is like almost not even responsive to the stock price. Whereas if we look at like the 900, if we do the 900, 1,500 call spread, the delta on this is 18 and the cost is 12,000. So it's a lot cheaper than buying a call option outright, but then you have capped profitability. So do you and your brother differ in trading strategy? That's a good question. My brother has strategies, like his own strategies that he's created that I don't really trade. I think overall we're pretty similar in our philosophies. Chris says, what does it mean when a stock is going ex-dividend? It means that the company is paying out a dividend to the shareholders, and the ex-dividend date is essentially when you have to own shares in order to receive the dividend. So if you own shares through a company's ex-dividend date, then you will effectively be paid that dividend. That is also the date when the share price is adjusted for the dividend. So typically, if a stock price is $100 and they pay out a $1 dividend, then after the ex-dividend date, the stock will start trading at $99. So essentially, the dividend price comes out of the share price, and that happens after ex-dividend. But mainly, you need to own shares through the ex-dividend date, before the ex-dividend date, and through it, so that you can get that you can get the dividend on the shares. LT asks, would a put debit spread instead of a naked put have protected you from this happening? It would have if both options expired in the money. So since the stock was at 793 and I owned the 800 put, it's unlikely that I would have had a spread, because if I had the 800 795 put spread, then both of those options would have expired and both of them would have been exercised / assigned, and I would not have sold my shares. But if I did have a spread, I would not have had the 800 795 spread. I probably would have had like the 800 750 or something like that. So it would have helped, but realistically it would not have, because I would have had a much wider spread that would not have fully expired in the money. SP says, where have you been, Chris? Mr. Videos. Thank you. I have been, the holiday season and winter is usually pretty busy for me, because first it's the holiday season, so I'm usually doing a lot of traveling for, visiting my family for the holidays. And then also my family exclusively does skiing and snowboarding trips, which also happen in the winter. So we just did one. We were in Steamboat for a week, and then we'll be in Big Sky in a month, a couple months. So winter is a little busier. Alexi says, what do you think about the tastytrade approaches of selling premium? So selling premium is a high probability trading strategy because you are going to make money more often than not. But what high probability trading strategies have in common, or when you're selling options, you have a limited profit potential and you typically have a lot of risk. So your risk is typically a lot more than your profit potential. So if we just look at an example, let's say I sold the 357. I'm going to the one standard deviation strangle here. So if I sell the 357, 408 strangle, or just choose any out of the money options and look at that strangle. So I can only make $462 on this strangle. So in 41 days, if SPY is between 408 and 357, if in 41 days it's between these prices, then this strangle will be worthless and I will make $462. However, my max loss is theoretically unlimited. So if we had a scenario such as March of 2020, where the stock market fell 30% and SPY went from, let's just say SPY went to 300, then if SPY was at 300 before these options expired, then this 357 put would have $57 of intrinsic value, which means that this strangle will be trading for $57, or have a total value. If we multiply by the option contract multiplier, we would get a value of $5,700 on this strangle. So if I sell this for $462, that's my max profit. But if the market tanks and this strategy sees its value increase to $5,700, then I will effectively lose, or I'll have a loss of $5,300. And so to make back $5,300 on a strategy where I can only make $462, I'm going to need 10 to 15 trades to get my money back. Then they all have to be maximally profitable at this rate to get my money back. So selling premium is a strategy where you're going to make money most of the time, because most of the time crazy moves don't happen. But the thing you need to watch out for is the big losses. If you can sell premium and you can consistently make money while also limiting your catastrophic losses and keeping those in check, then that is a system where you could make money consistently. However, it really depends on your system. So my number one piece of advice is that if you're selling premium as your main strategy, you must have some sort of way to limit your losses and not get blown out. Otherwise, you're not going to make any money selling premium, even if you make money on 80% of your trades. So that's my philosophy. So if you're joining now and you missed the presentation I did earlier, essentially, I had a Tesla position, and through the earnings week, I bought the 800 put in Tesla, and I accidentally allowed that put to expire in the money, and I sold my 70 shares, ended up with a short stock position of negative 30 shares, and accidentally locked in a short-term capital gain, which increased the taxes on the realized gain by thousands of dollars. So then I basically just closed the short position, and then I repurchased the shares and also missed out on some share price appreciation. But if you're just joining now, just replay the live stream when it's over and you can catch the full presentation that I did in the beginning. Someone says, can you show a live trade video someday? Yes, I'm planning on doing that very soon. I was going to do it yesterday, but I was busy running errands yesterday. Mohammed asks, hi Chris, you mentioned before that trading and YouTube are your main sources of income. How do you go about withdrawing cash from your trading activities? So trading is not a main source of my income. YouTube ad revenue is one source, and then affiliate marketing is the other source, and then the smallest source is direct course sales on the website, but that's like 5% of overall revenue, as basically the course is, if you sign up for Tastyworks and you use the project option referral code, then you can get the index options trader course for free. I'll leave a link in the description, or there will be a link in the description about that. But that's a great way to support the channel and what I do. It doesn't cost you anything out of your pocket. If you're looking for a new brokerage firm and you switch to Tastyworks and you want to support the work that I do, that's one of the ways that I make money, is through affiliate marketing for Tastyworks. So I don't actually do any withdrawals from my trading account because I'm not trading for a living. So I don't need to withdraw money regularly from my trading account. So to answer your question, I do not make any withdrawals. It's tricky. Well, first of all, hold on. Thank you for this. Thank you for the super chat. Kazar, is that how you say it? Kazar? How are you related to tastytrade channel? I saw you there in an old video. Appreciate your videos and work you put into this project option. So to give you a little bit of backstory, my freshman year of college in 2011, I was at Arizona State University and I was studying computer systems engineering, which is essentially computer science. And then I had sort of an epiphany, and I woke up one day and I realized that I wanted to go into finance. And so I transferred to DePaul University in Chicago and switched my major to finance. And then when I was going through that process, I was reading a ton about the stock market, and then eventually stumbled into learning about options. And then through watching YouTube videos about options, I came across a tastytrade video. Then I started watching tastytrade, and then I sent a couple emails to Tom Sosnoff, who is the co-founder of tastytrade, and he mentioned that they had some interns that were leaving, and I just so happened to be in Chicago and I was available. And so I went in for an interview, and then I ended up being an intern and later a full-time employee at tastytrade. So that's the backstory. I worked there for 3 years, and then in 2016, I left tastytrade to start Project Option because I somewhat developed my own philosophy and I wanted full control over how I got to explain things, and I wanted to own the content that I wanted to create. And so I just had this vision and I wanted to start something on my own and give it a shot. And so that is where Project Option begins in 2016. So thank you all for being viewers and making my dream come true. It's been a wild ride, but wouldn't change it for the world. Tastytrade just sold for $1 billion. That's correct. Super proud of all of them. Cameron asks, what happens if you buy Tesla calls and they have another split? What happens when a stock splits is the share price is divided by the split ratio. So before Tesla split 5-to-1, and Tesla shares were around $2,500 a share. So if Tesla splits 5-to-1, that means that the share price gets divided by 5. So it went from $2,500, divide that by 5, and that gets to $500 a share. But the number of shares outstanding is multiplied by 5. And so if you take the pre-split stock price times the number of shares outstanding, that gives you what is called the market capitalization, or the public valuation of that company. And so if you have these two numbers, the share price and the number of shares outstanding, if you divide the share price by 5 and you multiply the number of shares outstanding by 5, you get the same exact market capitalization. So a share split is just a way to change the stock price. Specifically, if you do a stock split, you are lowering the stock price, but you are increasing the number of shares outstanding, and the public valuation of the company does not change. So the only thing that really changes is the share price and the number of shares outstanding. The same exact thing happens to the options. So for example, if I bought the 1,000 call option in Tesla and Tesla did a 2-for-1 split, essentially the 1,000 call option would become the 500 strike call option. And instead of having one contract, I would have 2 contracts. And then the option price itself would also adjust based on the new stock price. So nothing really changes. You just have a different strike price for your option, and then you'll have a different quantity of options that you own. Let's see here. Split equals happy. Generally, yes. Generally, if you have a stock split, it's making the stock price much more accessible to more investors. And because of that, in theory, there's more demand for the shares because more people can afford them. And so that was kind of Tesla's strategy with their stock split. I don't really know when they split, but it was somewhere in here. Yeah, it was somewhere in here because Tesla was at $500 per share post-split. I don't know what Amazon's doing. Amazon needs to split their stock because to buy one share of Amazon, you need $3,500. They need to do a 10-for-1 split. Did you long or short Tesla? I am long Tesla. The original presentation in this video or this stream was about how I made a mistake and accidentally sold my shares and ended up short Tesla, but I corrected that very quickly. Victor asks, watched your other video for the first time. Very quality video and explanation, but I still have some questions. Do you answer questions? Where can I ask my questions? You can ask your questions right here. Someone asks, Luis asks, who owns the outstanding shares? People who own the outstanding shares include other institutions and individual traders like us. That's pretty much it. Anyone who buys the shares owns some of the outstanding shares. So that could be hedge funds, it could be other investment institutions, but it could be a lot of retail investors. And so there's a big collection of people who own the outstanding shares. Why stock split always goes up? Well, I would say that stocks do not always go up after a stock split. But theoretically, if you take Amazon, for example, if Amazon's at $3,300 a share, if Amazon does a 10-for-1 split, then they will have a share price of $335. And so if you take the stock price from $3,300 and now it's worth $335, then a lot more smaller investors can actually purchase the shares because they can afford a $300 stock, whereas before they could not afford a $3,300 stock. And so in theory, it increases the demand for a company's stock. And that's why it is viewed as a favorable thing generally. But just because a company does a stock split, it does not mean that the stock price is going to go up. Someone asked, how can shorting bring a company stock down? Well, first of all, it can bring the stock down because there's more selling pressure. But another reason it could bring the stock down is the perception of the company. So typically, if a big hedge fund shorts a company's stock, they'll typically try to advertise why they are betting against the company, and they'll try to publish things that kind of reduce or degrade the public's perception of that company. And then if people start to believe that that company is not a good investment because these hedge funds or experts are betting against it, then that could lead to other people selling their shares because they see the bad research or whatever, and they believe that the company is going to go down or fall in value, and so they might sell their shares as well. What is the average duration of your trades? How many days do you hold on average? It's a good question. In recent history, it's been very long. So if we look at The Tesla is the biggest position. If we look at this column here, which is days open, we can see that many of these positions have been held for longer than 150 days. So this call spread has been held for 160 days. This call spread's been held for 200 days. This call option has been held for 130 days, and then I turned it into a call spread 30 days ago. These shares, well, originally I bought them in between March and May of last year. So technically these have been held for like 9 months, but as described earlier in this video, I accidentally sold them and then I repurchased them. So let's go to MicroStrategy. So this is more of a short-term position. 2 months, 2 months, 1 month. Let's see here. FireX asks, which broker would you recommend for someone getting started? I think everybody should do their own research and research the major brokerage firms. And then also what's more important to me is the technology. So read into the trading platforms that these brokerage firms have. And then more importantly, look at their fees. I personally trade with Tastyworks, and that's because they have $1 to enter options. So $1 per contract to enter an option trade. But then when you close, you pay $0 per contract. And so technically it comes out to about 50 cents per contract between opening and closing a position. But you also pay additional small fees such as exchange fees, regulatory fees. And so I think it actually comes out to about 60 cents, 65 cents per round trip is what it's called. So opening and closing is about 65 cents per contract overall. Yeah, I trade with Tastyworks. I love the platform. It's very simple. I'm not personally someone who does a lot of technical analysis or use, complicated technical indicators and stuff like that. I don't really draw on the charts. I don't do active day trading, so I'm not buying and selling futures intraday. And so for me, Tastyworks is great because I just focus on options trading and very, very simple approaches. And I like how the platform works and I like the fees. And so that's who I trade with. But I think this is not a hard sell, but I think everybody should go and research the major brokerage firms and figure out which one works best for you. But I would definitely pay attention to trading fees. What platform for PC Mac is best for a beginner? So these days you can get the major brokerage firms and you can download their trading software. It doesn't matter if you have a PC or Mac, you'll be able to get it. So it shouldn't matter whether you have PC or Mac. Cameron asks, which would be better, buying Tesla calls on the next dip or buying Tesla calls after the next split? Well, they just did a stock split, and so I would not anticipate that they'll do another stock split for a while. But typically, if you were to play a stock split, I think that it'd be best to enter that position before they announce a stock split, because once they announce a stock split, people are going to try to front run the stock actually splitting in anticipation of a bullish move. So of those two, I would say the more likely scenario is that you buy calls after a dip. But what's a dip to you? Is that Tesla going to 800? Is that Tesla going to 700, 600? I mean, a lot of times people ask me super specific questions, and unfortunately I can't answer that because I don't know what Tesla stock is going to do. So for my position, I'm being more defensive now by hedging the aggressive directional plays that I did, which were long calls, and turning them into call spreads that can't lose any money, and then also purchasing put options here or there to protect against a big Tesla sell-off. But I can't tell anybody exactly what to do, unfortunately. To protect your Tesla from catastrophic drop, I thought you would buy a put rather than sell a put. I did buy a put. Can you go over some of your most recent open positions and why you decided to open them? I think MicroStrategy. So this is a good example. So this has been I've done this strategy many times. So MicroStrategy is a company, and they were the first company to come out and say that they were buying Bitcoin with their company assets. So all of the cash that they had in their company, they used the cash and converted it to Bitcoin, and they bought, I think, like $750 million worth of Bitcoin when Bitcoin was at 10 to 15,000, and now Bitcoin's at 40,000. And so this stock price increase is Bitcoin fueled. Since MicroStrategy owns a ton of Bitcoin, the stock price is now a proxy for a Bitcoin investment. So if you buy MicroStrategy, you technically have Bitcoin exposure, because if you own MicroStrategy and MicroStrategy owns Bitcoin, you indirectly own Bitcoin. So what I did is I wanted to make a bullish play in MicroStrategy in anticipation of Bitcoin increasing. And I also own Bitcoin itself, but this was kind of more of a fun play. But one thing I did 2 months ago was I purchased the 500 call option in the December 2021 expiration cycle, and I paid $78 for this option, so $7,800. 3 days ago, with this call option being super profitable, now it's at $42,000, so this call has increased by $35,000. What I did to protect this position is I shorted the 1,000 call option in the same expiration cycle, and I did this 3 days ago, and I sold it for $210 or $21,000. And so basically, if we look at this position, I own the 500 call and I'm short the 1,000 call, but I paid $7,800 for the 500 call, and I received $21,000 for shorting the 1,000 call. And so the result is that I own this bull call spread, meaning I've purchased this call spread, but since I did the transactions at 2 different times, and I did it, I shorted the 1,000 call when the 500 call was already massively profitable. Now I have a call spread with a net credit of around $13,000. And so basically I can't lose any money on this call spread. If both of these options expire worthless, I will make $21,000 on the 1,000 call, and I will lose $8,000 on the 500 call. And so the worst case scenario for this position is that I make $13,000. The best case scenario is that the stock price is above 1,000 in a year, and then this call spread is worth $50,000. So the width of the strikes is 500. If it is fully in the money at expiration, this call spread will be worth $500. And since it's currently worth $169, then it can make $330 more or increase by another $33,000. So basically the least I can make is $13,000. The most I can make is $50,000 plus $13,000, which is $63,000. So this is a position I'm just going to hold because I'm bullish Bitcoin. I think this stock's going to continue to go up because they own Bitcoin, and now I have a risk-free position in this call spread. Zach asks, what's the purpose of having multiple options accounts? It's a good question. So these accounts that you see here, this one right here, the bottom one is my personal margin account, and then this is a different margin account that is not just my money. So that's why I have two accounts. This is my personal margin. This is another margin that I have that is not just my money. And then this account at the top is an IRA, a SEP IRA that I have not funded because I decided to do my SEP IRA with a different investment firm. And therefore, I will not be funding this SEP IRA, but I have it. So the reason you'd have multiple accounts is maybe you have one IRA, which is a retirement account, and then maybe you have a margin account, which is not a retirement account. And so that's why you would have multiple accounts. Or you could open multiple accounts if you wanted to have one account dedicated to just buying and holding stocks, and then maybe you want another account that is strictly for options trading. That would be another way to kind of break up the two activities. So there's a number of reasons why you would want multiple accounts. Can you be taxed on stock shares you've moved, like sold NEO all into Tesla? So the way taxation works with trading activities is at the end of the year, you take all of the profits that you realized, and then you subtract all of the losses that you've realized. So let's say over the course of a year, I make $10,000 from short-term options trades that I've realized, meaning I open and close the positions and those profits are locked in. They're not unrealized profits, meaning that I'm still holding the position. They are profits that I've locked in. But then let's also say that over the course of the year, I locked in $10,000 of losses, meaning I realized losses equal to $10,000. And so I realized $10,000 in profits. I realized $10,000 in losses. My total P&L, or profit and loss for the year, is $0. And therefore, you don't pay any taxes because you didn't make any money overall. So taxation works by, it's not just the profits that you take, it's also the losses that you take. And then it's basically the total profits that you make. So if you overall make money by trading over the course of a year, then you will pay taxes on the realized net profit or loss. But if you lose money, you're not going to pay taxes. You'll actually your taxable income will be reduced by some of your losses. Rod Gomez says, your crypto is not really yours, nor safe in Robinhood. Read about it. I agree with Rod. The tricky thing with crypto and Bitcoin is that you have to spend a lot of time learning about it, and you need to learn some of the technical aspects of actually storing it, because it's not like holding cash in my Chase bank account. If I have cash in my bank account and I wake up one morning and $10,000 is missing from my bank account, I'm going to get that money back. Okay? But if you are holding Bitcoin through a third-party service, like let's say you have your Bitcoin in Coinbase or you have your Bitcoin in Robinhood, if you wake up one day and the Bitcoin is gone from either of those sources, your crypto is gone forever. You're not going to get your money back, because with crypto, basically, there's a saying in the crypto universe, and the saying is, not your keys, not your Bitcoin. So by keys, they mean what's the private key, or do you actually have in your possession the private key that can access your digital wallet. So there's a public address with your wallet, and then there's a private key. You need the private key to access the Bitcoin or crypto in your digital wallet. If you are storing your Bitcoin with Robinhood or something like Coinbase, you do not have possession of your keys, meaning that Coinbase or Robinhood, they are custodying your crypto for you. They hold the Bitcoin for you, and it's kind of like an IOU that you have. But you are not the one with access to the keys that accesses the Bitcoin that you have with Coinbase or Robinhood. And so if somebody hacks your Bitcoin through holding those services, then your crypto's gone forever. And so hardcore crypto people will always custody their coins themselves. So if you are a hardcore Bitcoiner and you're taking it very seriously, then you are going to be the one that is in full control of the private key that accesses your digital wallet and allows you to send or spend Bitcoin. So if you're getting into crypto and let's say you want to buy Bitcoin, I would recommend learning about hardware wallets, which somebody has mentioned. So a hardware wallet is essentially a fancy USB drive that you plug into your computer, and that stores your keys to your Bitcoin. And so it's not stored online, it's in the fancy USB drive that you get, and that's how you can access and send or spend your Bitcoin or whatever crypto that you have. The problem with that is when you do get a hardware wallet, when you set it up, you write down a recovery phrase, which is basically 24 different words in order, and it's just these random words. And basically, you're going to keep that on a piece of paper or something, and you're going to have to store that in a very safe place, because if you lose your hardware wallet, meaning the fancy USB drive, if that burns in a fire or something, or you lose it, or you misplace it, then the only way to get back your keys is to use the recovery phrase that you've hopefully written down and stored somewhere safe. But if you lose your hardware wallet and you lose your recovery phrase, then your Bitcoin is gone forever. And so there's a lot of risk in terms of actually storing your own Bitcoin, but it's the best way as of now. In the future, there will likely be services that make this much less of a headache for people. But for the time being, if you own a substantial amount of crypto assets, the best way to do it is to store it yourself. But unfortunately, that comes with some risk. So I would also look at multi authentication. I forget what the technical name for it is. But basically, you can set up what I just talked about, which is having a hardware wallet, but you could have like 3 of them, and then you need 2 of the 3 to access your Bitcoin. And that's safer because then you can distribute your hardware wallets in different locations, and as long as you have 2 of the 3, then you can access your Bitcoin. So it's much safer than just having one, but then you have to manage and properly choose where you want to put these multiple hardware devices. Bro Truth, thank you for the $2 super chat. I appreciate it. Bro Truth asks, benefits of trading under a LLC or corporate entity. Unfortunately, I can't answer that question because I'm not a tax expert. But I will look into that, and if you send me an email, I'll get back to you. Do you own any Dogecoin? No, I do not own any Dogecoin. Always store and remember your seed, otherwise you are done. That is correct. So storing crypto is tough because it's one of those things where like you need to take it very seriously and you need to be very careful, because like if you have the hardware wallet and then you have the recovery phrase, you can't tell, and yet like you have to protect those things very carefully, because if you lose both of them, then you're done. And so you really can't even tell anybody. You can't say, hey, can you watch my recovery phrase for me? Because then technically that person who has your recovery phrase, they can steal your crypto assets. And so it's very tricky in terms of security when you're storing Bitcoin. And for that reason, I'm not gonna say how I store my Bitcoin. People are asking, do you offer option alert services? I do not. I do not offer any options trading alert services, and I don't think I will. The reasons are, first, if I have an options alert service, then that is going to really eat into my flexible schedule. And one of the reasons that I started Project Option is so that I could have more freedom in my life with where I am and when I work and where I work. And so if I have an options alert service, basically that is a form of imprisoning me, because Monday through Friday, I have to be watching the markets all day long. Because if I'm charging people money to follow what I'm doing, then I need to be super on top of those positions. And for that reason, it's going to really limit my freedom. And that's one of the reasons why I don't have an options alert service. Second reason is that trading and markets are so unpredictable, and I can't guarantee somebody that if they pay me $100 a month that they're going to make money following my trades. And I don't like the idea of that. So I don't do it. Byron Foster, thank you for the $5 super chat. I appreciate it. Is it true that leaps held for over a year as taxed as long-term capital gains? I believe so. Again, for all I know about options, I don't really know that much about option taxation. And for the most part, the reason for that is most of the time when you're trading options, you're going to be holding for less than 1 year, and therefore it's going to be taxed as a short-term capital gain. One other thing that I can tell you about trading options is that there are certain products such as SPX. If you trade SPX options, your profits from trading SPX options will be taxed by a short-term and long-term mix. So it's like a 60-40. So I think 60% of your profits will be taxed at a long-term capital gain, and 40% of your profits will be taxed at the short-term capital gain. So there is a tax benefit to trading options in something like SPX. And I believe futures trading and futures options also fall into that category, which is called Section 1256. But again, I'm not a tax expert, so please double check the things that I'm saying about this. But I know SPX for sure is considered Section 1256. So if you trade options on SPX, then it will be a more tax advantageous scenario than trading options on something like SPY. Where do you live? I live in Denver. Matthew Clemens, college? Yes, I went to Arizona State for 1 year in 2011, and I studied computer science. And then my second through fourth year, I was at DePaul University in Chicago, and I studied finance. And I graduated college in 2015. Actually, 2016? I don't even know anymore. Lauren asks, so how should you buy crypto? What I do, or what I have been doing, and maybe people here in the comments will tell me a better way, but I purchase crypto using Coinbase. I use Coinbase Pro, and I buy the crypto, and then as soon as I buy it, I transfer it out of Coinbase. Mad Notes, I salute you, my guy. Thank you. He said, I just want to thank you for your content and keeping it real, transparency. That's what it's all about. From day one, my goal was to keep it real on Project Option. If you go back to all of my content and watch every single one of my videos, you will find that I have never made an exaggerated claim, and I've never tried to sell people, holy shit, on false dreams. So I'm just trying to keep it real. I like to present material neutrally and honestly, and then I like to let people use that material as they see fit. I'm not here to flash a Lamborghini in your face and say you can have this if you follow or buy my services, because That's all bullshit. Bro True, thank you for the $22 super chat. Do you think the Fed-induced bubble will burst soon? My answer to that is, do I think it will burst soon? No. Let me come back to this for a second. Dear Bob, thank you for the 100 check super chat. I have to do the conversion on that. I don't know how much that is. Thank you. He says, what's your entry strategy for Leaps, and what do you think about Facebook 200 calls in January 2023? And last thing, I made a cash account on Tastyworks. If I make a new one, can I just send money between them? Thank you. I believe you can transfer funds between your existing accounts. You should be able to do that. What's your entry strategy for Leaps, and what do you think about Facebook 200 calls, Jan 2023? Facebook, Jan 2023. 700 days. I like your style. 200 calls though. So Facebook is at 268. He's talking about the 200 calls, which are in the money. So these calls here have $68 of intrinsic value, which means the remaining, if we take 92 minus 68, that gives us about $25 of extrinsic. Let's check. $25. There we go. So if you buy this call option, first of all, it's going to cost you a little less than $10,000. Your delta will be 78, which means that's approximately equivalent to owning 78 shares of Facebook, since if you have a delta of 80 or 78 and the stock price goes up by $1, you're expected to make $78 on this call purchase. Honestly, I like this trade. I mean, I probably wouldn't buy the 200 strike, just because if I'm going to put money on the line and if I'm going to make a 2-year play that's bullish in Facebook, then I probably wouldn't buy in the money. If I'm going to spend 10 grand, I'd go to like the 300 and buy 2 of them. That's what I would do. Or even further out. It depends on how bullish you are, but I like what you're thinking. The thing is, do you want to buy an in the money call and be safer and more conservative and spend more money? Or do you want to be more aggressive with the potential return that you can make and go out of the money and buy more contracts and therefore get more leverage? That's the question. But my entry strategy is just to have a bullish outlook on a company or stock, and then put on some super bullish trades in there. But typically, like you're saying, I go long term. Man Lin, thank you for the $49 super chat. I really appreciate it. That's a costly premium. Yes, it is. Does Coinbase charge a fee when you buy and sell? Yes, they do. Steven says you have a great channel. I subscribe. Thank you, Steven and Dad Reviews. I appreciate you. This is a really interesting question. Dean asks, does theta work against delta in real time? I love this question. This is a great question. Let's nerd out a little bit. All right. Facebook. Let's go to Facebook options that have 41 days to go. Well, first of all, So I'm just going to sort through regular expirations. What we're going to do is we're going to look at March Facebook options with 41 days to go. And then we're going to look at February Facebook options at the same strike price. And we're going to look at the deltas. So does theta work against delta in real time? The answer is yes. And there's actually a Greek that describes this, but I forget what the Greek is. It's a second order Greek, but basically it's called delta decay. So delta decay, let's talk about this. Facebook is at 268. Let's look at the 275 call option in March. So the 275 call option in Facebook with 41 days to go has a delta of 0.42 or a delta of 42. So if I buy this call option, which is the 275 with 40 days to go, and Facebook goes up or down $1, I'm expected to make or lose $42 based on this delta of 42. Now, this delta is also sometimes used as an approximation for the estimated probability of the stock price being above the call option strike price. So in other words, this delta of 0.42 is a rough estimation equating to a 42% probability that Facebook is above 275 in 41 days. So there's a approximate 42% likelihood that the 275 call is in the money in 41 days. So let's look at the 275 call in the February expiration cycle. So remember, 275 call in March, delta is 42. If we go to February, we have 13 days until expiration. If we go to the 275 call, the delta is 0.32. And this means that if I buy the 13-day 275 call and Facebook goes up or down $1, then I'm expected to make or lose $32. Okay? So if we remember, the March contract, the March 275 call with 40 days has a delta of 0.42, indicating that the option is expected to make or lose $42 with a $1 change in the stock price. And also, there's an implied 42% likelihood that the 275 call is in the money when it expires in 41 days. But the February 275 call with 13 days to expiration, which means much less time until expiration, this call option has a delta of 0.32, indicating an implied 32% probability that Facebook is above 275 in 13 days. And then if we even go to a weekly expiration, see if there's a more short-term one. If we go to the 6-day 275 call, the delta is 0.23, indicating an estimated profit or loss of $23 if Tesla goes up or down $1. And then also an estimated probability of 23% that Facebook is above 275 in 6 days. And so, does theta work against delta in real time? The answer is yes. So, as time passes, the delta of an out-of-the-money option will approach 0. As an option approaches its expiration date, the delta will decrease towards 0. The delta of in-the-money options, as they approach expiration, the delta will approach 1 or -1 if it's a put. And so basically, out-of-the-money options, the delta will decay towards 0 as the stock price, as the options stay out of the money and as they get closer to expiration. And for in-the-money options, the delta will increase towards positive or -1.0 if the options are in the money and the stock price is remaining in the money relative to those options, and then the expiration is also approaching. So that is called delta decay. And to make it everything I said short, delta decay means that an out-of-the-money options delta will approach 0 as time passes, and an in-the-money options delta will approach 1 as time passes. Nice shot. Thank you for the super chat. I appreciate it. He says, I have an iron Condor in Zoom for March 19th. Call spread 450 to 490. Let's go to Zoom. In March 19, he has the 450, 490 call spread. So he's got this. There we go. And he has the 310, 270 put spread. 310, 270 put spread. So these spreads are both 40 points wide. The iron Condor is currently trading for $15. The stock price is, let's see here. So he's got the 450, 490, 310. Where's 310? There it is. And then 270. So this is these are the strikes of his iron condor. So he's got the 450, 490, 310, 270. Zoom is currently at 420. So as you can see, Zoom is closer to the call spread than it is to the put spread. So the put spread is really not in danger here. But if we think that Zoom is going to continue increasing, then this call spread could be in trouble, and therefore the entire iron condor could be in trouble. So he says Zoom was range bound but suddenly spiked to around 415, as we just talked about here. Do you think I should roll my put or call spread? I don't want to tell you what to do, because what do you think is going to happen? If you think, well, first of all, right now you're really not in danger, okay? Because the stock price is in between both of your strike prices. You could see Zoom go up, and then maybe it goes back down, and maybe it stays range bound for you. You do have 41 days, so that's a pretty decent amount of time. I would say if this were me, I wouldn't be doing anything right now. I would wait until Zoom makes a big move in either direction. And the classic way to manage this would be if you wanted to roll up the put spread because Zoom is going up, then essentially you would buy back this put spread, and then you would sell a higher put spread, and you would collect more credit, which would increase the profit potential on the iron condor. But more importantly, it would decrease your maximum loss potential, assuming that you kept this put spread the same width. So if you moved both of these strike prices up and kept it in the same expiration, you would collect more credit, and that would increase your max profit, decrease your max loss. However, then you would have a much tighter range of max profitability, and therefore the probability of making money on the trade would go down. But that's more of a defensive mechanism. So I can't tell you exactly what to do, but for right now, if this were me, I would not do anything. Samantha, thank you for the super chat. I appreciate it. What's a good low risk strategy for newbies? My philosophy is to stick to spreads. So if we go to Apple, Apple's a classic example. And let's say you think Apple's going to continue this massive run up, and you want to be bullish on Apple. Well, instead of going to Apple and saying, okay, I'm going to buy the 140 call, which is probably what most beginners would do, they'd probably buy an out of the money call. Instead of doing this, which costs you $500, $455, you would do a spread. So instead of buying a call option, you would buy a call spread. So maybe you do the 135, 130 call spread, and now your maximum loss is 235 as opposed to 450. So your max loss is half as much, which is good. When you're a newbie, you want to risk a very small amount of money because you're not going to be killing it right away. It's going to take you a long time before you get to the point where you could be killing it. Unless you get really lucky right out of the gates, but that's not really common. So another benefit of this is if you buy the 135, 140 call spread, your break even is 135 plus 235, which is 137.35. As opposed to if you bought the 140 call for 450, then your break even is 144.50. So you need the stock price to go up way more when you buy a call compared to if you bought an at the money call spread. So my recommended strategy for newbies is to trade vertical spreads, which is like buying a call spread or selling a call spread if you want to sell a call spread or sell a spread, or buy a put spread and sell a put spread. So those are 4 strategies. I have a very in-depth video on my channel called Vertical Spreads Explained for Beginners, or Vertical Spread Option Strategies for Beginners. And that is a 90-minute video that breaks down vertical spreads in excruciating detail. So I would recommend watching that video to learn about vertical spreads. Samantha says, maybe I need to take that down to a further newbie level. So another way to trade options with less risk is to trade lower priced stocks, because lower priced stocks are going to have cheaper options, and on a dollar basis, the stock price is not going to move around as much, which kind of ties into the lower option prices. But let's say you go to AMD, and then maybe you wanted to do a bullish spread in AMD, so you do like the 87.5, 90, and then this would cost you $110. So there are lots of ways to do it. Unfortunately, if I were to make a recommendation as to how much money you would need before actually starting to trade options seriously without like risking a ton of your account, I would probably say like $5,000. Like honestly, $10,000 is ideal. $5,000 is probably like my minimum, the minimum number that comes to my mind when somebody says, how much money do you need to actually trade options? I would say $5,000. Because if you have $5,000, then you can put on a position with a loss potential of $250, and you can risk 5% of your account. Whereas if you had $1,000 or $2,000 and you risk $250, you're risking more than 10% of your account. So Tasty Troll, what strategies do you use the most? It varies based on market environment. Right now, the strategies that I use the most are long calls, long call spreads, long puts, and long stock. So buying stock, buying puts, buying calls, buying call spreads, or legging into the call spreads as I've described many times. Donnie says you want to buy in low volatility options and sell in high volatility. I don't necessarily agree with that. The thing with volatility is option prices scale with the realized movements being observed in stocks. So the VIX is the S&P 500 volatility index. So what this does, the VIX measures option prices on SPX with approximately 30 days to expiration. So they're going to go to, I think, 23 to 37 days. So they're going to take all the options from the 23-day expiration up to the 37, and they're going to take basically every single option from all of these expirations. They're going to apply a very complicated calculation to these option prices through this time frame, and they're going to calculate a 30-day implied volatility, which is the VIX. And so if we look at the VIX, what happened, this is measuring option prices directly. So what happened in March of 2020? The market was extremely volatile because it fell 30%, and the market was moving around like 5% every day, and therefore the option prices were much more expensive. Now, if you look at it, the market is moving around a lot less. The market is much calmer now. Well, I'll look at SPX so you don't get that choppy chart. The market's much calmer now than it was here in March of 2020. And so with less volatility in the market, or the S&P 500, smaller daily price fluctuations, there are now cheaper option prices because of the smaller market fluctuations. And so when there are cheaper options in low volatility, the options are cheaper because the market is not moving around as much. But just because the options are cheaper, it doesn't mean that they are better to buy, because you're buying options, and when you buy options, you need big movements to make money. And when the options are cheap because the market isn't moving around a lot, you're putting on a position where you need big market movements in an environment where there are small market movements. And the opposite is true when you're selling options and they're super expensive. So in March of 2020, if you sell options because they're super expensive, Well, they're super expensive because the market is moving around a lot. And by selling options, you're putting on a position that makes money when the market is not moving around a lot. And by selling them when they're expensive, you're putting on a position that requires the market to not move around a lot when the market is moving around a lot. And so option prices scale with the observed volatility in the market. And so it's not as easy to just say you should sell options in high volatility when they're expensive and you should buy options in low volatility when they're cheap, because by definition, you're putting on a position that requires the opposite market environment to make a lot of money. But I'm not saying that you can't make money selling options in high IV, and I'm not saying that you can't make money buying options in low IV. I'm just saying it's not that easy. And if it were that easy, then everybody would be rich doing exactly that. And there's a book called Volatility Trading by Yuan Sinclair, I think. I'll type it in chat. There's a book that I just typed in chat, and he did a whole section on selling options and the profitability of option selling strategies. And he talked about something called variance premium or volatility premium. And what that is essentially what is the edge in selling options in different market environments, different volatility environments. So if the VIX is at 20%, implying a 20% probability, and the realized volatility is 15%, then you would say the variance premium in that case would be 5%. And this is very high level stuff, and I could be explaining it a little bit incorrectly, but generally I understand the concept. But what he showed was actually selling options in higher volatility environments was actually a worse and worse trade the higher the volatility was. So he showed that actually selling options in low IV was better than selling options in high IV, historically speaking. And the reason for that is in higher IV environments, higher volatility environments, the variance premium was actually lower and in a lot of cases negative, meaning that it was a losing proposition to sell options in high IV, whereas it was a much better proposition and a more profitable strategy to sell options in low IV. And I know that's completely opposite from what you may have been taught in the past. Donnie asks, thank you for that. Dude, are you Mike? No. Mike is my older brother. Eli's confused now. Sorry to confuse you, Eli. Is it better to sell or buy during high IV environments? Based on everything that I've seen, based on all the research that I've done, and based on the things that I have read, it is better to sell options in low IV as compared to selling options in high IV. And I will go on the record saying that. That is based on the data that I have seen myself. That is based on the things that I have read. But when I say that, I'm not saying that you cannot make money selling options when they are expensive. Because if we look at this here, if you're selling options in March of 2020, and let's say the VIX is at 90, and then you sell that option position, and then the next day the VIX is at 80, and there wasn't a big market movement, then you would have a big profit on that option position because the option price is contracted so much because you had a short option position on and there was a quiet day, and therefore the option price is contracted very quickly. And so you can make very quick profits in that scenario. But what I am saying generally is if I had to make 100 trades that were all mutually exclusive, meaning they weren't correlated with each other, if I had to make 100 trades and I had to put those 100 short option trades in a 15 VIX environment or put them in a 50 VIX environment, I would easily say sell these 100 option positions in the 15 VIX environment, and I would make that decision very easily as compared to selling in a 50 VIX environment. Another reason is if you look back historically, we don't really have a lot of data for super high implied volatility environments. Someone asks, what is IV? IV is implied volatility, which is implied volatility measures option prices. So implied volatility is essentially looking at the option prices on a particular product or stock, and then it's giving us a percentage that indicates the expected range for that stock that is implied by the option prices. So when the option prices are a lot more expensive, then there's a much wider expected range in the stock, and we call that higher implied volatility, as compared to a similarly priced stock where the option prices are much cheaper, and they're much cheaper because the market expects smaller movements or implies smaller volatility or less volatility from that stock in the future. So what I was saying is, if we look back 10 years, or let's go 20 years monthly. If we go 20 years back and we look at the monthly chart of the VIX, we can see that a vast majority of these dates are VIX below 30. There's only a couple times where we had the VIX above 50 for that matter, or really above 30. So we have this one big spike here, which is 2008. And then we had a small blip in 2011 that went right back to low IV. We had a small blip in 2015, went right back to low IV. We had a small blip in 2018, went right back to low IV. And then we had this big event last year where the VIX went to 85, 90. And we are still we're still in a high volatility environment. But where I'm going with this is we don't have a lot of data to work with to analyze super high implied volatility options trading. And since we only have a few short time periods where the VIX was at super elevated levels, we don't really have a lot of data to work with in trying to figure out whether buying or selling options is better when the VIX is at super high levels. So, Sir Norris, thank you for the $2 super chat. I appreciate it. NRZ $16 calls for May 2021 for 5 cents each. Do you like it? No, I don't like it. I don't like it based on buying 5-cent options, but I'll go ahead and look at it. NRZ, May 2021, 100 days to go. The 16 strike for 5 cents. I do not like this play. Mainly, well, let's see here. I don't like this play. You only have a couple months for this stock to go up 60% just to get to the strike price. If you want to make money on it, let's say you need it to go to 16.5 or 17. So let's say you need the stock to go up 65 to 70% to make decent money before May. So you have 3 months, and it hasn't really appreciated that much at all in the past few months. So like you haven't seen a 70% increase in the past few months. And so to me, to buy the 16 call options expiring in 2 months, 3 months, and paying 5 cents each for those, I don't like it. I think that's you're probably going to burn the money that you put into that trade. But if you want to do that, just put a very small percentage of your account into it, like 0.25%. Because if you think about it, if you put 0.25% of your account into this trade and it 10x's for some reason, then you make 2.5%. But if you're paying 5 cents each for them, then it could easily, if something crazy happened in NRZ, then you could have like 100x or like a 50x. And so if you put 0.25% of your account into that and you get a 50x, like that's a huge return. But based on what I'm seeing here, this looks like a losing trade to me. And for that reason, I would not put serious money into it. And again, I don't know anything about this company, so maybe you know something that I don't know. And if you know something that I don't know, then I would go for it. But like I said, keep the risk small. Eli says, I still don't get it. You are selling volatility as an option seller. More volatility equals more money. you're correct in saying that, right, when you sell options, you are selling volatility, meaning you think it's going to go down. However, just because you're selling options based on high implied volatility, you still have directional exposure. And when you're selling options in high implied volatility environments or high VIX environments, there's a lot of market movement. And for that reason, you're selling expensive options, and they're expensive because there's a ton of movement. And you're not only isolating the volatility, you're exposed to the directional aspect as well. But also, just because you're selling a more expensive option, and this is the point that I'm trying to make, just because you're selling a more expensive option, it does not mean that you have a better chance of making money than selling a cheaper option. And based on what I said about this guy's book, Yuan Sinclair Volatility Trading, he did an extensive study on this, and his findings were that even though you are selling more expensive options in high IV, on average, it actually lost money because the market was moving around more than the options were implying. And vice versa in low IV, the market movements were very small. And even though you were selling cheaper options, then since the market movements were super small, you were still actually capturing more of that volatility edge, so to speak, compared to selling options in super high IV. Like I said, there's not enough data to really, at least I don't have enough data to compare it, but there have only been very short time periods in the last 20 years where we saw super high market volatility, especially like sustained high market volatility. And therefore, we can't really analyze. There's much less data to analyze in the super high IV environments compared to the lower IV environments. That's all I know. But I'm not saying that you can't make money selling options in high IV. I'm just saying it's not as easy as it looks. Let's see here, looking for another question. Eli, search stuff like volatility. Search variance premium versus market volatility, or variance premium versus VIX. I'm sure there's some interesting stuff that you can find on the web, probably by Yuan Sinclair. Hyper Reason, thank you for the super chat. I appreciate it. Sorry, I left you hanging there for a second. Tesla 1000 call, March 19. Do you like it? It sounds short term. Tesla, March 19th, 2021, 1000 call. I don't love it. I don't love it because I don't like going this short term. It's a very easy way to vaporize your money, so to speak. That's a term that we toss around a lot in the chat with some people that I talk to on a daily basis. But like if you buy this 1000 call, first of all, you have to pay $2,300, and you have 40 days for Tesla to go from 850 to 1000 just to get in the money. Obviously, if it goes from 850 to 900 in the next week, then you're going to make money on that trade. But I don't love it. I like going, if I'm going to make a bullish trade on a stock, a super bullish trade, then I like to go longer term, pay a higher dollar amount for those options, and probably go deeper out of the money, and then just have more time for things to work out. I don't like making super directional bets on a less than 2 month time frame. Let's see here. Michael, thank you for the $5 super chat. I appreciate you. Michael asks, if I already own shares of a stock and I sell a covered call option against my shares, will the new cost basis reflect on whatever trading platform you use? I sell a covered call. So if you own shares of stock and you sell a call option against my shares, will the new cost basis reflect on whatever trading platform? I don't think it will change what it says your share purchase price is. You just have to keep track of that. So what he's basically saying is, if I buy 100 shares of stock for $200 per share, and then I sell a covered call and collect $10 in premium, and that option expires worthless, I make the $10 premium or $10 profit on the call. I purchase the shares for $200. So technically, my cost basis on those shares is $190 because you paid 20 grand for 100 shares at $200 a share, and you made $1,000 by selling a $10 option that expired worthless. So basically, you own 100 shares for an effective cost basis of $19,000 or $190 per share. I don't think that your trading platform is going to tell you that your new effective share price is $190. You're just going to have to keep track of the fact that you made a profit on that covered call and then subtract those profits from your effective share purchase price. But also keep in mind that you will have to pay taxes on the profits that you make from the covered call trading if you profit from your covered calls over the course of a year, and also if your overall profitability from your trading activities is positive, then you're going to have to pay taxes. So just keep that in mind. Eli asks, to be delta neutral, is that the answer? That's not what I'm saying. What I was saying from the volatility thing is that when options are cheap, it doesn't mean that they're easy to buy or better to buy. And when options are expensive, it doesn't mean that it's better to sell them. That's all I'm saying. Because the option prices scale with the amount of volatility being observed in the stock market. So if volatility is really low, then the option prices will be cheap. If the market volatility is super high, the option prices will be expensive. And in both of those cases, the option prices are matching the observed volatility in the market. And so it's not as easy as saying you should sell options when they're expensive and buy them when they're cheap, because if you think about it, the options are cheap because there's not much market movement, and therefore you're buying options when there's not much market movement. And when you buy options, you need a lot of market movement. And then when you're shorting options, you make money when there's little market movement, and you're selling them when they're expensive, and they're expensive because there's a lot of market movement. So I'm not saying you need to be delta neutral. I'm just saying it's not as easy as saying sell options when they're expensive and buy options when they're cheap. It's not that simple. At the end of the day, you have to be right about your prediction. And when you're trading options, you are exposed to direction. Even if you enter a directionally neutral trade, you will be exposed to direction as the stock price moves away from whatever your position is. Thank you for the $2 super chat. Paras, I don't know how to say your name. Thoughts on Tesla 1375 January 2022 call. Tesla 1375 Jan 2022. 1375. I mean, these are generally, here's what I think. If I think Tesla is going to go up over the next 1 to 2 years, and I think it has a lot of upside potential, then I'm going to go to one of these longer term expirations, probably more than a year. I'd probably go further out than Jan 2022, such as June 2022 or even a year later. And then I'd go to this option chain or the 2-year expiration, and then I would look at some out of the money options. That's what I would do. And then you look at the strike prices, figure out what you're willing to spend and how bullish you are, and that's how you decide what strike price to purchase. If you were, Adam, thank you for the super chat. I appreciate it. If you were predominantly bullish options trader, how would you prepare for a market crash? I sell mostly bull put spreads and naked puts. Well, I don't really prepare or predict a market crash. What I do, or I have been doing, is protecting the positions that have been the best to the portfolio. So Tesla has been a phenomenal position, but what I've done since opening this position is I've hedged away a lot of the risk, and I've turned a lot of these spreads into positions that can't really lose a lot of money. But then also I will occasionally buy a put against the position. And again, it's kind of an art to choosing what strike price or how far out you want to go. But essentially, I'm looking at how much money the position has made and how much I'm willing to spend to protect against a catastrophic sell-off in the stock. And then a similar thing in MicroStrategy. This has gone very, very well, but I've basically turned it into, I turned this call spread or call position into a call spread that can't lose any money. And I also have a put that's going to expire soon, but this isn't really doing anything. And so that's kind of how I approach it. Is I'm not going into SPY and buying a bunch of puts or buying VIX calls to bet on a market crash. I'm just trading the positions that I have that I've done really well with, and I'm protecting those positions however I can. Whether it's converting a call into a call spread and reducing the risk and the directional exposure, or if it's directly buying a put. Question, does Tesla ever go down? Yes. Tesla goes down sometimes. I mean, before coronavirus, it went from $1,000 a share to $350. That's a 65% drawdown. And then it went from 500 to 330. That's a pretty sizable drawdown. It's 35%. But for the most part, it's been going up. But that's why I've been protecting it, because I understand that this trajectory can't last forever. So I'm trying to take advantage of it while I can, and that's why I've turned the risky call positions into risk-free call spreads so that I can confidently continue holding the position and continue to make money. But then if it all turns around, I'm not going to lose all my unrealized profits and also the risk that I had initially. I'm hedging against that. But then I also have a share position too, which is something that I don't need to really actively manage because I can hold those forever. Chad asks, Chad, thank you for the super chat. Lots of super chats coming in. Thank you, everybody. It's a great way to support me and the channel. Chad asks, why is tastytrade so option seller centric? If the data says otherwise, what would you say is a counter to their model? So I think first and foremost, it's easier, since selling options is a high probability strategy, you make money more often than not. So it's a good foundation for consistent profitability, because when you're selling options, more often than not, you will make money on those trades. But the downside of those positions is that you have a ton of risk. You have a lot of loss potential relative to the amount of money that you can make. And so the key when you are selling options as your foundational strategies is that it's easy to see favorable outcomes for your trades because it's a high probability strategy, and more often than not, the stock price isn't going to completely violate your strategy, especially if you're trading in something like the S&P 500, which is a much less volatile index as opposed to like selling strangles in Tesla. My counter to the tastytrade model would be that I don't think it's right. I don't agree with completely shutting anything out. Like I don't agree with saying option selling is good and buying options is always bad. Like that's my problem with the tastytrade philosophy, is that I wish that it was more of an open-minded thing where it's like you can buy options and you can sell options, just understand what can work for you and what can work against you when you apply both of those approaches. And so it's not that I'm saying tastytrade is wrong and saying that selling options is a good thing to do. I'm just saying that based on what I have seen and what I have read, I don't think that selling options in high IV is as good a strategy as they think it is. And that's probably the fundamental difference in our philosophies. But overall, I do agree with a lot of the tastytrade philosophy. But there are some differences there. My whole thing is that I like to be more open-minded, and I think it would benefit everybody to not villainize buying options just because you're working against time and you need the stock price to work in favor of your position, just understand that when you buy options, you need this to happen, and you have a time limit. And if you are wrong, you're going to slowly lose money. But when you're right, you have massive profit potential, and when you're wrong, you have limited loss potential. And on the contrary, when you're selling options, just understand that most of the time, it will be easy to see a favorable outcome for your position. And with that, you need to just be aware of the fact that when you're selling options, you have more risk than profit potential. And the number one key is to keep the losses in check by whatever sort of management that can accomplish that. And so I like buying options a lot, but I'm not going to sit here and say selling options is bad always. I'm just saying you can buy options, you can sell options, understand what needs to happen in both of those camps and understand the drawbacks of both of those approaches, but you can use both of them to your advantage when you see fit. And so that's my philosophy, is just being a little more open-minded and not completely shutting out one approach altogether. And that's kind of the end of it. You can make money buying options. You can make money selling options. That's the end of the story. Mike, thank you for the $2 super chat. I appreciate it. He says, what would be your ideal strat if you had to start with $2,000? My ideal strategy, well, first of all, if I'm starting with $2,000, I'm probably just getting started, because you said if you're starting with 2,000, so you're learning options. I would say trade very small and experiment with lots of different strategies, and maybe even go shorter term so that you can trade more. The goal when you're starting out is not to make money. The goal when you're starting out is to learn how options work, learn the market mechanics, observe the positions that you're putting on, and see how they're performing relative to time passing and also relative to the stock price changing. And that is the primary goal when you're just getting started. You should not be getting started with $2,000 assuming that you're going to kill it and you're going to make $10,000 in your first year. It's not going to happen. It's very unlikely to happen, I should say. My ideal strategies, though, I would say vertical spreads. Vertical spreads are probably my favorite strategy, especially for beginner traders. And that's because you can really limit the amount of money that you're going to put at risk. So like I talked about earlier, if you want to trade Apple, you could go and you could put on a $2.50 wide spread. You could risk $100. And then you could watch this spread every day relative to changes in Apple and see how it's changing. Or you could do a different strategy, like let's say you put on a butterfly. So you could sell two of these, the 135s, and you could do this butterfly position. Although that was actually not a butterfly. 130, 135, 140. That's a butterfly. So you could put on this butterfly position and your max loss is $70. And you need the stock price to stay near 135 over 40 days for this to make money. But if you put this position on, if you observe it every single day as time passes and as Apple changes price, that is how you are going to learn how options work. Most of your learning with options is going to come from real experience. Stephen Liu, thank you for the $10 super chat. I appreciate it. Love your content. Thank you. He says he learned a lot from me. How would you trade Tesla going forward? The way I'm trading Tesla going forward is how I've been trading Tesla, which is somewhat hands-off. I'm not trading every single day, but I am adjusting the position based on what happens in Tesla. For right now, I'm just kind of sitting tight, not really doing anything. I'm happy with where the position is. I have these two call spreads in here that they don't have any risk at all. So I'm not too worried about the Tesla position. I'm just sitting tight and seeing what happens with it. If Tesla continues to skyrocket, then I will probably continue to put on downside hedges, such as just buying put options. And that's because if Tesla keeps skyrocketing, the position is going to make so much money that I'll be able to afford spending a little bit to protect against a big downside movement. So that's how I would do it. Leon 20 21st. Thank you for the $5 super chat. I appreciate it. Leon asks, hold on, Leon, I got to catch up on these. Sorry, I got to catch up on these. Yesterday I bought Neo 7080 June 2021 call spread. What do you think of this buy? Neo June 2021. June 2021. Why don't I see June? Interesting. 7080. Well, first of all, you have, if it's in June, you have like 130 days. 70-80 call spread. I mean, I don't really know. What do I think of it? I think it's a bullish trade, and I think if you're trying to minimize your cost and potential loss of this position, I think buying the call spread is a good play. If we look at the 70 call, that's trading for $700, but if you do the 70-80, you significantly reduce that, and you still have really good risk reward. But it's going to require that Neo gets above $80, and also you need time to pass for that position to really get near that max profit potential. Gregory Whiting, thank you for the $5 super chat. I appreciate it. Typically, what's your trading day like? Are you watching your screens all day long? Absolutely not. Some days, some weeks even, I look at the screen very little. And by look at the screen, I mean logging into like the desktop platform, but I do check the stock prices every single day, multiple times a day on my phone. And I can do that because I know that I don't have any positions that can blow up the entire account. And I know that these are all positions that are primarily longer term holds. And so with that portfolio setup, I know that I don't have to watch the screens all day long. And I don't like trading approaches that require me to watch the screens all day long. Sorry, everyone. There's so many questions. I gotta knock out these super chats quick. Blood asks, thank you for the super chat. Blood asks, how do you feel about buying calls on stocks that are somewhat cheaper, like Remark Holdings? Is it better to buy the underlying stock in that case? I don't know what Remark is. Mark. So this is a $4 stock. It's a penny stock, technically. Hard to borrow. Let me see here. 10% borrow rate. I don't know. I wouldn't trade this stock personally. One problem I have is a lot of people ask me about my opinion on stocks, and the stocks that they mention I've never even heard of. My general advice, especially if you're newer, is to stick to stocks that if you brought up in conversation, people would know what company you're talking about. So that means trade Facebook, Apple, Shopify, Tesla, Square, Nvidia, Zoom, Expedia, JP Morgan, Goldman Sachs, Activision, Visa, Roku, Chipotle, United Airlines, Southwest. Trade these companies that have good option markets, or just stick to something like SPY, which is the S&P 500, or IWM. That's my general advice, because in these well-known stocks or well-known companies, the option markets are going to be way better. If I go to Remark, the options they're decent, but they're not great. And on a $4 stock, you're kind of limited with what you can do. So if I went to the July 2021, like the highest strike you could buy would be the 5.5, which you do have 160 days. But again, since this isn't a more active option market in Remark, there's not as many options, quite literally, because you can see that the furthest expiration is 160 days out. Whereas if you go to something like Apple, you can trade 2-year options, and you can trade way more strike prices than you'd be able to get in Mark. So that would be my honest opinion. If you're bullish on Remark Holdings, I'd probably buy the stock, or do a combination of buying the stock and buying some long-term options. But again, there's not that many options that you can trade on that stock because it's not super active. Jock, thank you for the super chat. I appreciate it. I have 200, 2.5 Mara March options. If you think something will continue to rise, is it worth rolling the expiration for the extra cost? So I don't know what the stock is. It seems like it's a penny stock or a lower price stock. Oh, it's 22.5. So you have the 2.5 March. You have these calls. If you have the 2.5, that's essentially like you basically own the stock, because a share of stock is essentially a call option with a strike price of 0 and no expiration date. And if we look at the one strike call, it's trading for 21.75, and the stock price is at 22.50. And so it's essentially like the delta right here is 99.8. So buying this one strike call is essentially like buying 100 shares of stock. So it's not much different. If you think something is going to continue to go up, then yeah, it would make sense to roll your option position if you want to keep it rolling. If you want to keep exposure to your option position, then at some point you're going to have to close it, especially if it's getting near expiration. And then once you've closed that initial position, you don't necessarily have to roll it to the same strike. You could just establish a different position based on where the stock is now and then what you think is going to happen going forward. Steven, thank you for the super chat. I appreciate it. Do you think selling at the money monthly Tesla put spreads from now until 2022 is a good strategy? At the money monthly put spread. So he's saying like go to March 2021, and if I'm going to enter this today, Tesla's at 850. So he's looking at selling the 850 put, and then maybe you buy the 800 put, and this is your put spread. It will be a good strategy if Tesla continues to go up. But the benefit of this is that as opposed to what I'm doing, which is buying calls, I need Tesla to go up a lot to make money, because I have a higher break-even price since I'm buying out of the money options, and I have a time limit, and that's working against me. So the benefit of doing something like this is if you sold this 850, 800 put spread for $22, your break even is 850 minus 22, which gives us a break even around 828. And so with Tesla at 850, you have some downside room. And over the next 40 days, as long as Tesla stays above 828, then you will make money. So it's a higher probability strategy. But the downside of doing something like this compared to what I'm doing is that if Tesla goes from $850 to $1,000 before March, you're only going to make $2,200. And then once Tesla's at $1,000, now you have to sell the 1,950 put spread or whatever. So you're going to have to keep selling put spreads higher and higher, and you don't have the benefit of uncapped profitability. You have defined profitability when you sell the put spread, but you do have a higher probability of making money compared to buying a call option like what I'm doing. Ariel, thank you for the $5 super chat. Just sold my 50 MWT and I got a leap instead to sell covered calls. With a bullish assumption, do you think it was a good idea? Should I roll it at some point? MWT, I'm never going to catch up here. MWT, I don't know what that is. Maybe I can't look at it. But you sold your shares and you got a leap instead to sell covered calls. So you bought a long-term call option, and then you're going to sell calls against it. So my thoughts on this is that if you have a super bullish assumption, then I don't think a covered call is the right strategy, because when you're trading covered calls, you don't want the stock price. Well, technically you do want the stock price to increase with a covered call, since you'll make your max profit faster. But technically, if you're trading a covered call and you want to keep the shares because you're bullish long term, then you don't want to sell your shares And for that reason, if I'm super bullish on a stock, I will not trade a covered call. I will just have the shares and I will hold the shares. I'm not going to sell calls against it. And that's because if I'm super bullish, then I don't want uncapped upside profitability, which is what you get when you have a covered call. George, thank you for the $5 super chat. Just jumped on. What's your thoughts on the Lucid CCIV potential merger? Are you in out? Honestly, I haven't read about this, but I'm aware of Lucid as like the super premium electric vehicle company. What's Lucid doing? What's their ticker? I don't even know what the ticker is, but I'll have to do research on that. I haven't really read about it yet, but thank you for the super chat. I appreciate it. Everyone's trying to get in on CCIV. Mardochi. I don't know how to say your name. I'm sorry, but thank you for the super chat. X, July 2016, U.S. Steel. July 2016, 2021. 160 days to go. 28 call. Oof, that's out there. That's out there. Let's see here. What I do like about this trade is that it's, well, first of all, we've had a pretty big run up here. It's retraced so far, but if you are bullish, hyper bullish on this stock, which sounds like you are, if you want to buy the 28, I would say that's fine. Just understand, like I said before in another example, just understand that this is a very bullish trade, and you should go into this expecting or accepting the outcome of losing everything that you pay for that option. Also, one thing I will point out, the open interest of the 28 call is 75 contracts. And so I would go to the 25 call because the open interest is at 1,000, which means that there are more people with open contracts in the 25 strike call, and there are more people trading this option compared to the 28. Or if you don't want to go to the 25, then you go to like the 30. But the way I would trade this is if you put on this position, and U.S. Steel surges over the next 1 or 2 months, and then you have a big profit on this position, then what I would do is I would look to do something like I've done with my Tesla position, which would be to short a higher strike call to turn your risky long call position into a spread. And so by doing that, you will reduce your risk, and sometimes you can eliminate all your risk in that position while still allowing for more profitability should the increase continue. Satish, I don't know how to say your name either. I'm sorry. I'm pretty bad at pronouncing these names, but thank you for the $10 super chat. I really appreciate it. WMT is what he meant. Again, if you're trading Walmart and you sold your shares, but you have a bullish assumption, if you have a super bullish assumption in Walmart, I don't think a covered call is the right strategy. I do not think the covered call is the right strategy for any stock that you have a super bullish assumption in, because when you trade a covered call, you are quite literally shorting the call and you are collecting premium in exchange for giving up all of your upside profitability above that call strike. So you're selling your upside profit potential. And if you're super bullish on a stock, I don't think that's ever the right play. Dr. Nitton, thank you for the super chat. By the way, I have to get off soon, guys. Dr. Nitton says, do you plan on having more courses in the future? Also, I use IB, just 1.5% margin rates, better than tastytrade. Thoughts? I don't have experience with IB, but from what I know about IB, they are much more geared towards like professional level traders who know very well what they're doing. And from what I've seen, the Interactive Brokers software is not as usable. It's not as user friendly as something like Tastyworks. But from what I know, they do have they do have a good setup for like professional level traders, and sounds like they do have better margin rates. So I don't know, it's whatever you want. Like if you want a more usable platform with great fees, then something like Tastyworks is probably what I'd recommend for most people, especially if you go to a different brokerage where the trading software that they have is not as usable. Then I think that actually poses additional risks, because then you are exposing yourself to execution risk, meaning that you do something that you didn't mean to do because the software wasn't as easily usable as a different piece of software. So that's what I would say. And do I plan on having more courses in the future? Potentially. I'm definitely keeping the door open on that. I am going to continue expanding on the index options trader course. I'd love to have that be like a beginner options trading, like zero to hero type thing, where not only is it educational content in regards to managing a systematic market neutral option strategy in the S&P 500 and then providing data, but on top of that, providing additional strategies to trade on the overall market index, and then also have it be very clear in terms of like options trading for beginners. So maybe include everything that I had in my options trading for beginners course in written format with additional examples, and then maybe add in my vertical spread ultimate guide, and then just kind of build out that course to be like a great resource for beginner options traders. And then also have the analytical side of it as well. Jock, thank you for the super chat. Is it possible to pay / get a one-on-one? Right now, I'm not doing one-on-one mentoring. I know a lot of people are interested in that. And if you would like to know, if you were to pay me for one-on-one mentoring, I would be telling you the same things that I say in these live streams. So it doesn't feel like it's a one-on-one because there's lots of people watching. But if you were to ask me these questions in a one-on-one paid session, I would give you the same answers. So you should kind of see these live streams as sort of a mentoring program, because this isn't like a structured educational video like a lot of my other videos that I've done in the past. This is much more like get inside my head and I explain things in depth, and I don't necessarily worry about creating a super engaging educational video. Mark asks, do you buy options more in the money or out of the money? Typically, I buy out of the money options with a lot of time until expiration. That's what I've been doing for the past year, and it's worked out very well. But again, when I put on those positions and they work out, I hedge the risk out of them and turn them into trades that can't lose any money relative to the starting point. Donnie, it's all right. We do look alike. We looked more alike in the past when I still had hair, but we surely sound similar. But yeah, thanks for watching. John Doe asks, what trading platform do you trade options on? I trade on Tastyworks. Be sure to check the link in the description after I post this. And you can check the link in the description for any of my YouTube videos. But if you don't have an account with Tastyworks and you research them and you decide that you want to try out an account with them, and you also want to support Project Option and the work I do here, and you also want to get the options, the exclusive course that I have on the website, then you can do that by signing up and funding a Tastyworks account and using the referral code Project Option. That is a phenomenal way to support the channel. Doesn't cost you anything out of pocket. I'm not selling any expensive trade alert services or courses. I do make money selling a course, but it's a very small percentage of overall business revenue. So be sure to check out that offer in the description for any of my videos, or this video after I post it, which will be very soon because I have to go soon. Stefan, thank you for the super chat. I appreciate it. Is Tastyworks available in Canada? Not yet, but they will be. I think there's a lot of regulatory hurdles you have to go through to have a U.S. brokerage open in Canada, but stay tuned. I think they're working on that. I mean, they want to be everywhere ideally, but like I said, there's regulatory hurdles. Cade, thank you so much for the super chat. What's your opinion on scalp trading? My opinion on scalping is it's a riskier activity because it's a much shorter term directional trading activity. So scalping is when you buy and sell something and you're typically doing it within one trading day. So it's essentially day trading is scalping. I don't usually do that. I've done it in the past, but my success with scalping has been very volatile because it's extremely hard to predict accurately short-term price movements. And the shorter term you go, the more it is like gambling, in my opinion. Dr. Nitton, thank you again for the super chat. Great live stream. Thank you. Yes, that is the same course. The course that I'm mentioning is the same course you'd get by opening an account with Tastyworks and using the referral code. And then you'll get that course for life, and then all updates that are made to the course, you'll never have to do anything additional to keep access to it. Roshanisha, I recently opened Tastyworks platform by your referral code. Thank you so much. I appreciate it. It's a phenomenal way. It's the best way to support the Project Option channel. How do I get your course? Go to the website and then go to the contact page. Go to projectoption.com, go to the contact page, and then send me an email letting me know. And then I will correspond with you and get you into the course ASAP. Mr. AM, he says, oh man, I really like this channel, but knowing you're shilling a paid course really makes me skeptical. That's fair. And guess what? 95% of this industry is extremely predatory. But to be fair, if you watch my options trading for beginners video, there are websites who are selling all of the content that I gave everyone for free in a 3-hour video. And there are people who will sell that information for $1,000+ So when you accuse me of being a fraud because I sell a course, just understand that I understand where you're coming from, but at the same time, I give out so much content, 99.9% of it is free, and I give out information that people charge money for on other sites. And the information that is in the course cannot be found anywhere publicly on the YouTube channel or on my website. So I understand where you're coming from, and also I don't actively promote selling the course. I much prefer to give people that course for signing up for Tastyworks and getting it that way, because then they get the course, they didn't pay money out of pocket for it, and they also get connected with Tastyworks, which is a great brokerage firm to trade with. And so I understand where you're coming from, and it's a completely fair thing to call me out and say that you're skeptical because I'm selling something. But if you go to my website, you will not easily locate the sales page for the course. And so I'm not actively promoting it. If you look at the description for a lot of my videos, I don't have a link that says buy the course here. It does exist, but most people get it through opening an account with Tastyworks, and that's how I prefer it. I make 95% of the money that I do from Project Option through methods that do not cost the end user $1. Looking for more questions. Let's see here. Stepan, I don't know how to say that name. Thank you for the super chat. I really appreciate it. he says, what do the letters like PQN near the stock ETF price on the top of the trading platform mean? PQN. Are you talking about my trading platform? PQN. I'm not sure what you mean. Then I asked, are you close to Mike? Not geographically, but yes, he's my brother. We're close. Looking for more questions here. Dean says, I'm just jumping on now. What do you teach? Well, it started as a presentation where I talked about a mistake that I made with a Tesla position that I had by basically forgetting that I had a put option and I allowed it to expire in the money, and it completely messed up my stock position and I lost a little bit of money on that. But the bigger consequence was tax related. Dean, once I upload this video after the stream ends, you can rewatch the beginning portion of that. Mark, thank you for the super chat. He asks, is there an approval process on Tastyworks for level 3 trading? Can't get into verticals at other places without that application approval process. So Tastyworks has a basically all-inclusive full privilege margin account called the Works. So when you go to apply for an account or open an account, if you select margin account and you select the Works is what it's called, you will get access to every single options trading strategy. So you'll have full options trading approval as opposed to a tiered approval system, which other brokerage firms typically use. Vince asks, thank you for all the info. You're welcome. He's asking, why do I not trade out of a Roth IRA? Well, I don't have a Roth IRA. I have a SEP IRA that's managed elsewhere. But yes, if you do have a Roth IRA, the benefit of a Roth IRA is that you can trade it and you don't pay taxes on any of your gains. So a Roth IRA is essentially you're funding a retirement account with post-tax money. So you get money, you get taxed on it, and then you put money into an IRA, a Roth IRA specifically, and then you don't pay taxes on any of the gains that you make in that account, as opposed to a traditional IRA, which is where you put in pre-tax money, and then when you take the money out, then you're taxed on the money that you have when you withdraw from your traditional IRA. So yeah, I do see trading in a Roth IRA as an advantage, especially if you make a ton of money trading in a Roth IRA over a multi-decade period, because when you take out the money, you won't have to pay taxes on it. So it's definitely an advantage. The thing is, you can't like if you made $1 million in a Roth IRA, unfortunately, you can't take that money out. Otherwise, you're going to pay a 30% penalty or whatever it is. Virgin Galactic, SPCE, thoughts? I like it. I think that's an interesting stock to play because it's in a completely new industry, which is space travel and, well, not space travel, like commercial space flights. And so I think that's where we're headed. Right now, we're only kind of hanging out on Earth, but I think within my lifetime, AKA within the next 50 years, we will definitely be hanging out more in space. And so I think Virgin Galactic is a very interesting play. Does Tom give you a beret when you work at tastytrade? Unfortunately not. Now that I think about it, it would be nice to have a beret, but he didn't give me one, unfortunately. Is it safe to trade crypto on Tastyworks? It says it's not insured. And again, I talked about this earlier. if we're talking about trading crypto, like buying and selling it for short-term trading activities, then yeah, I would say it's safe. However, I would not buy and hold crypto assets long-term on any third-party site. If you're going to buy and hold crypto long-term, especially if it's a sizable amount of money, then you need to look into self-custody, which means you hold the crypto assets through something called a hardware wallet, or multi-authentication, which is basically like you have multiple hardware wallets and then you need all of the different keys or a majority of the keys to access your crypto assets. That's the best way to do it, unfortunately, right now. So there is a lot of user error when it comes to properly storing crypto assets. Someone asks, Oria asks, why was your put a taxing mistake? Because I accidentally allowed the put to expire in the money, and therefore I sold the Tesla shares that I had, and that locked in a profit by selling the shares. And I wanted to hold the shares long term, meaning more than a year, which would then be taxed as a long-term capital gain. But since I accidentally sold the shares and I held them for less than a year, the taxes on them is now going to be considered a short-term capital gain, which is typically much higher than the long-term capital gains tax. Next to the ticker when you search for a stock. Q. I see what you're saying. This thing here. I think someone said it's exchange related. I don't know what this letter is. Q136Q. I'm not sure. It's a good question. All right. Virgin Galactic is a heavily shorted stock. Check the short interest. That is true. But you could argue that a high short interest is a bullish indicator, as we saw in GME. Because if there's lots of people who are betting against the stock through shorting the shares, if that stock price surges higher, then the short positions are going to have really big losses, and the only way to reduce the exposure in their short positions is to buy shares, which is called covering the short position. So as the share price goes up, the shorts have bigger losses, and they may be incentivized to close some of their position, which means they would be buying back some of the shares. And if the share price is going up and they are buying shares to cover the short, then they're going to fuel the flames of that rally. And so you could argue that high short interest is actually a bullish indicator, because if the stock for some reason shoots higher, then there's going to be a lot of short positions that are going to be covered, which means they are going to be buying shares into the rally, which will further fuel the rally. Someone, ATO, I don't know how to say your name. Chris, was that a fat finger mistake? No, I just forgot that I had a put option expiring because I was driving into the mountains to meet my family for vacation. So I forgot that I had a put option that was expiring, and then by the time I remembered, the market had already closed and it was in the money and it was too late. Javier, send me an email. Go to projectoption.com, go to the contact form, and send me an email, and we can talk about that. Thank you for the super chat, ATO. I appreciate it. Was your mistake a fat finger mistake? No, it was not. I simply forgot that I had a weekly option in Tesla that was an earnings protective put, and I forgot that I had it, and I checked the stock price, and unfortunately Tesla closed at $7.93, and I had the 800 put, which means that it expired in the money, and I didn't want it to expire in the money. I should have closed it, but I forgot about it, and so it was a forgetful mistake, not a fat finger mistake. DMS Chris, what's the reason you stopped selling premium at all times? Easily gives best edge. Well, my philosophy, as I've kind of alluded to, is that selling premium is not as good in volatile market environments. And if we base volatility off of the VIX, since the VIX measures option prices on the S&P 500 and the option prices scale with volatility, as we can see here, for the past year, we have been above a 20 VIX. So this is a sustained high volatility environment. And in my opinion, it is not as favorable for option selling. Although now with the VIX like right above 20 and less than 30, I think it is a better environment now for selling options. But also in the past year, I had really bullish outlooks on stocks. And then also with the government coming out with their helicopter money, so to speak, and shooting all the bazookas they had and trying to stimulate the economy and flood it with money, my philosophy was that risky assets would do very well and technology stocks would do very well. And so that's why I stopped doing as many market neutral strategies and I started doing heavily directional strategies, which worked out very well. Ian, thank you so much for the super chat. Love your content. Thank you. Thank you, Ian. He said, I purchased 3 vertical spreads for Tesla January 2022, 870, 1500. And now I'm a bit nervous about the all-time high sentiments in the market. How many put contracts should I buy? You have 3 vertical spreads, Tesla January 2022. Yeah, the 870, 1500. 870, 1500. And you're worried about the all-time high sentiment. So he's saying he's worried that the stock is at all-time highs and maybe people are going to start selling into it because it's gone up too much too fast. Well, the good thing is with this trade that you have a year. And so if you think that Tesla is going to continue going up over the next 3 to 6 months, then this could be a really good strategy. But you just have to understand that if in a year Tesla is below your break-even price of 1,000, since 870 plus this 130 price, that gives us a break-even of 1,000. If Tesla is below 1,000 in a year, you won't make money on this trade. But again, I don't know what your entry price is. It could be lower than this. But again, people ask me for my opinion on what they should do. It depends on what you think is going to happen. Like, do you think Tesla is going to continue trending higher over the next 3 to 6 months or 6 to 12 months? If so, then I think your trade will do well. But just understand that your break even is somewhere up here and you need Tesla to continue going up. Dr. Nitton, thank you again for another super chat. I appreciate it. He said, great stuff, Chris. I just signed up for Tastyworks. Look forward to your course. Can I interview you for my own YouTube channel as an options expert? Go to, well, first of all, thank you for signing up for Tastyworks. And be sure to send me an email through projectoption.com and go to the contact page. Send me an email there so we can start talking via email, and then we'll go from there. Dirk, thank you for the $5 super chat. Thanks for the response on the Virgin Galactic short interest. I agree that it is a bullish play. I have taken calls on BYND for that reason. Beyond Meat, let's go. Love your channel. Thank you. What's Beyond Meat doing these days? Oh, geez. I was trading Beyond Meat earlier last year. I was trading Beyond Meat like around here, right around here. I had some bullish stuff in Beyond Meat, and I think I made some money. But this is insane. This move is insane right here. So we went from 140 and then it got up to 220 in 2 days, and now it's back at 170. So I don't know. So yeah, you're saying you took your trade based on short interest. Let's see here. Borrow rate is not too high. Borrow rate is 0.22%. Typically, if you try to short a stock and it gives you a notification, it'll tell you the borrow rate, and the higher the borrow rate is, the more heavily shorted a stock is. because the higher borrow rate means that there are less available shares that can be shorted. So it's you have to pay more for it. So GME's 5%. Virgin Galactic not long ago was at like a 60% borrow rate. So Tim says, sucks not knowing what I don't know. Yeah, I feel your pain too, man. Don't get discouraged. This stuff takes a long time to learn because there's a lot to know, obviously, and the best way to learn is to be involved with it consistently and over time. I've been doing this consistently for 8 years now. 8 years. 9 years? I don't know. I started in 2012, 2013. So just keep that in mind. You'll figure it out. What is Tastyworks? Tastyworks is a brokerage firm that is owned by tastytrade. Tastyworks is an options-focused brokerage firm, and their trading software is what I'm looking at right now. And they have really awesome commission rates for active options traders, and especially if you trade big size, because they have the capped commission rates. So like if you traded, let's say you're at some other brokerage firm and they charge you $1 per contract. If you wanted to buy 1,000 call options, you would pay $1,000 in commissions to enter that trade, because you would pay $1 per contract times 1,000 contracts, which gives you a $1,000 commission. But with Tastyworks, they have a commission cap at a maximum $10 per leg. So if you wanted to buy 1,000 call options on Tastyworks, you would not pay $1,000. You would pay $10 on the first 10 contracts, and then for the rest of the 1,000 contracts, you would only pay the exchange and regulatory fees. So like if I go to, let me just double check that. I don't think they changed it. But yeah, like if you, well, I can't do that because that would be too much. Hold on, let me go back to this. Let's just do 100 contracts. So yeah, so if I wanted to buy 100 of these options, it says here, it says my commissions is $10. So if you're trading elsewhere and they charge you, let's say $1 a contract, you would pay $100 in commissions to enter the trade. But on Tastyworks, they have a commission cap of $10 per leg, which means you only pay the $1 per contract for the first 10 contracts. And then for the rest of the contracts, you only pay the regulatory and exchange fees, which are like 10, 15 cents a contract, if I'm not mistaken. So, well, as of this estimated fees, it would be like 13 cents a contract. So it's very advantageous if you're trading more than 10 contracts to trade with Tastyworks, because they do have the commission cap. George Lynch, thank you for the super chat. Get on that Doge rocket to the moon. I mean, if Elon Musk is tweeting about Dogecoin, then I guess I got to get into it. Fayaz, thank you for the super chat. I appreciate it. All right. I think that's going to do it. I'm going to hop off. Thank you, everybody, for tuning in. It's been fun. Usually I do the live streams during the week when the market is open, because it's fun to kind of look at what's happening in the markets and have real option prices that are currently being traded, and then walking through my positions as they're actually changing live. But I decided to do a Saturday live stream today because I wanted to see what kind of audience we could get on a Saturday, because I know most people are working when I normally do the live streams during the week.